So Steve, August was quite an interesting month in the capital markets. The S&P was down about 6%. You had interest rates declining instead of rising. You had weakness in the credit markets. We had the VIX over 40 for the first time since 2011. So I noticed in the closed-end fund market, the average closed-end fund was down about 3.4% on a total return basis. So where does this put us on a year-to-date basis from a closed-end fund performance standpoint?
Closed-end funds have certainly underperformed the broader capital markets year-to-date. Looking at each asset class individually, the equity funds are down about 12% year-to-date. About 2% of that comes from discount widening. Taxable bond funds are down 4%, and 100% of that loss comes from discount widening. Muni funds are flat. The muni funds, the net asset values were up 1%, but the market prices were down from discount widening. So you're flat for munis, down 4% for taxable bonds, down 12% for equities, and the whole group is down about 600 basis points, and about a third of that comes from discount widening. Now, what I think is interesting is all the talk about market corrections and bear markets and various asset classes. So when we look at the closed-end fund market and just looking at equity funds specifically, about 40% of the equity closed-end funds are in a bear market, defined as down 20% from the year-to-date high.
Really?
And 80% of funds are down over 10%. On the fixed income side, the scale is going to be different, but about 35% of fixed income funds are down 10% from their recent high. And 75% are down over 500 basis points. And so you're having a lot of losses from discount widening in the closed-end fund market that aren't necessarily being felt by the broader capital markets.
Steve, a lot of people think about closed-end funds in terms of discounts. So how does this total return story sort of translate into where we are from a discount standpoint?
Our listeners will know that a lot of the discount widening happened since April. A lot of the underperformance occurred from April to the month of July. And so we had a couple hundred basis points of discount widening during those months. This month, discounts didn't really widen that much. The month it started with a 9.2% discount and closed at a 9.8% discount. And what I think is fascinating is that on August 24th, when the Dow dropped 1,000 points, the VIX hit 40, discounts widened out 125 basis points for the day. And so what that really shows us is that a lot of fear is already priced into the market. That doesn't necessarily mean that the asset classes, the net asset values have priced in all of the fear in the broader capital markets, but the closed-end fund that owns these asset classes, many would have thought VIX 40 means 300 basis points of discount widening. And that really didn't occur because discounts are already at such a wide base. If the average discount was 5, and the Dow drops 1,000 points, discounts could easily widen out 300 basis points that day. But that didn't occur because we started the month at such a wide discount. And where we are today, looking back over the last 20 years, discounts even at the month end are narrower about 95% of the time.
So Steve, in overly simplistic terms, does that imply that maybe closed-end funds were a little bit of a leading indicator for some of the market volatility and market declines that we saw in August?
Yes, sometimes the discount discounts future events, but in this case, discounts have been wide for such a prolonged period of time that bond funds were wide in 2013, 2014. Obviously, the fixed income market performed well in 2014, and so that wasn't a good indicator of future performance. To be determined whether wide discounts today are a leading indicator for the future. But again, discounts have been narrower 95% of the time. The average closed-end fund discount is 4.4. We're right around 10% today. And that average has occurred during periods of high capital markets volatility, low capital markets volatility, rich asset classes, cheap asset classes, fair. It's the long-term average. And so where we are today looks pretty good.
Steve, the last couple of months you talked about the overall backdrop of discounts being pretty attractive. Are there any parts of the market specifically that you find more interesting than others as you look around?
Equity closed-end funds certainly haven't grabbed as many headlines because discounts haven't widened out quite as much. But when we think about the equity closed-end fund space, it's very attractive to pick up some actively managed equity funds at 17% discounts. Discount volatility is going to be lower on the equity funds as it's been historically. On the fixed income side, the story is the same as what we've been saying for the last few months. You can buy over 100 funds at discounts wider than 15%. And so that gives you plenty of ability to choose your asset class, choose your manager, and really get that nice margin of safety of buying that asset class at 85 cents on the dollar. Specifically, when we look into the fixed income space, we like funds that have had strong year-to-date performance, and there are many cases where funds have actually increased the dividend. So you have a good fundamental setup, and then you have a good story in the closed-end fund space. We think those funds would be some of the first to snap back if and when discount volatility subsides.
Steve, thanks for your comments this month. Anything else you'd like to add?
Yes, I'd add that RiverNorth will be hosting a webcast on September 17th. The time will be 3:15. Patrick Galley, our Chief Investment Officer, will be leading the call. And I think that'll be a great opportunity to learn more about the closed-end fund space, our views on the opportunities, and specifically how those opportunities impact the RiverNorth funds.
Great, Steve. I'm assuming everybody can go to the RiverNorth website to sign up.
Yes.
Steve, thanks for your comments this month.
Thank you.